It's March 22nd, 2009. This is Maximize Utility. I want to make an attempt to name the economic events that have been happening since about 2007 through 2008 and into the present. People have been thinking that these are events beyond a normal business cycle, so it just isn't a regular recession. So they want to put some kind of special name to it, and they've kicked around the Great This, and they've used the Depression term and so on. Let's see if we can put a name to it to represent what it really is. Naming the events. We're talking about the economic and financial events of 2007, 2008, 2009. Notice I don't say naming the crisis or the crunch or whatever. It may not be a crisis. If you've been spending way too much for a long period of time and then you spend less and your GDP goes down, maybe that's not a crisis. Anyway, let's see if we can put some bounds in it. Is a recession? Yes, it definitely qualifies as a recession. Since about December 2007, we've been in a recession according to NBER. Is it a depression? That's a term we usually use when we say the Great Depression, the economic event of the 1930s. I don't think this is a depression. When you have $10 trillion worth of consumption, and consumption's only gone down a smidgen, I don't think that's a depression. Is it both the financial and economic crisis? That's definitely true. Both the financial sector, meaning stocks and bonds and wealth quantities, and the real economy, meaning jobs and industrial production, so on, both have been affected. Is it just an East Coast thing, or is it a global thing, a national and global thing? And sometimes these events are just on the East Coast, and the media picks it up in the streets, and they think it's happening all over. But indeed, this event is happening all over the world and all over the United States, although it is concentrated in some parts of the country. Is it a Wall Street and Main Street thing? It's definitely both Wall Street and Main Street. Is it an income and wealth type of event? It's definitely both income and wealth. Now, wealth is just your housing wealth and your stock wealth, and income is your flows, your salaries, and your bonuses, and the jobs, and the number of jobs, and the number of hours you work. And it's definitely affecting both of those quantities. Let's see if we can isolate a key term or a key concept that summarizes the whole event. Originally, we were told it was a credit crisis. People didn't want to lend to each other. It was a flight to quality. People weren't going to take risks. They didn't believe risky assets could return high rates of return as they had in the past. We told it was liquidity, that there wasn't enough money out there to be loaned. People didn't want to loan it. We were told it was a counterparty thing. We didn't trust our counterparty. We didn't know who was on the other side. And all along we were told it's a deleveraging, that we had too much leverage and we borrowed too much money. All those things are valid. In a bigger sense, it looks like it was a reevaluation of risk, that we looked at the world out there and thought there was more risk in the things we were doing. And also there was a reevaluation of the rates of return we could expect, that we didn't think we could get double-digit rates of return, that hedge funds didn't return 20% per year. Here are some more terms that we kicked around. There was the idea of the bubble. There were bubbles everywhere. In particular, there was the housing bubble. And then there was the idea of imbalances, all kinds of imbalances, the U.S. trade deficit, the U.S. budget deficit, all kinds of imbalances. And then there were just general ideas about there being froth in markets, or that markets would go to excess. There was a cycle, and the cycle went way to excess. And of course, one of the more specific things was the securitization, in particular securitization of housing debt. And derivatives was a key term kicked around. AIG, perhaps the arch-villain in the whole episode, had a ridiculous amount of derivatives outstanding. Now let's look at the major aspects of policy at the government side. First, there was standard monetary policy, lowering the Fed funds target rate. Didn't seem to do anything. And then we embarked on monetary policy, buy out the entire system style. Buy out investment banks, buy out insurance companies, get to the commercial paper market. Again, monetary policy we had never done before, an attempt to buy out the entire system. And then we came back on fiscal policy, something we had abandoned before. First it was tax cuts, and now big-time government spending, and a rebirth of Keynesianism and the belief in a multiplier. And perhaps it's all about a person or a personality. So we got to look at the heroes and the little geniuses. There's Ben Bernanke, the head of the Fed, a former Tweed Coat professor who knows all about the Depression, doesn't want to repeat a depression, so he's going to buy out the world. There's Hank Paulson, ran Goldman Sachs successfully, tried to run the U.S. economy. The greatest of the little geniuses, Lawrence Summers. Another new little genius, Timothy Geithner, speaks Chinese. Christina Rama, another Tweed Coat, she believes in the Keynesian multiplier. And then, of course, there's the naysayers, the Robert Barrows and the Gary Beckers and the Nicholas Rubinis, who say either it's not going to work or it's curtains. So those are some of the terms and some of the names. I could come up with many, many more. Oh, we could talk about it in a more detailed way, try to focus on something. Great economist John Taylor, for example, says it's all about counterparty and not liquidity. But that's to pick a union for what we're trying to do here. Let's try to get to the major ideas. I think markets work. I think capitalism works. I don't think policy works. I think if there was a cause of the crisis, it was more so on the government side, bad monetary policy, and then the attempt to take over the world and thereby put moral hazard in every decision made by every private party out there. I saw a big shakeout of things like hedge funds. I never believed there should have been 8,000 to 10,000 hedge funds beating the market by double digits. I always thought that was ridiculous. And the same thing with Goldman Sachs is out there. I don't think they should have had 20 and 25 and 30 to 1 leverage. And the same thing with the real estate flippers. I think people bought houses that were too big for them, and I'm glad to see that they don't have them any longer. And I think what you're seeing is a reevaluation of the rates of return. And for the longest time I said rates of return had to be bounded by world GDP growth, and everybody sneered, no way, we can get 10% per year. But that's what I think you're seeing. I think you're seeing a shakeout and a rectifying of the way markets should work. So what do we name it? What do I think we should call it? I've seen various people say different things. I read a Cambridge Associates report, and they say, how about the Great Recession? I think that's a cop-out. It's not a recession typically. And I saw noted investor Ray Dalio. He says it's the D process. It's the deleveraging process. And then I toyed around with all the adjectives and ideas, great, and I talked about solutions and upshots and reversions, the idea that the market was taking over and there was the end of policy in macroeconomics, and the rectification, and I tried to again put an adjective in the front of it, and this is what I came up with. The macro denouement. Denouement, that's a term from literature, how at the end of a story, all the intricacies of the plot come together and everything falls into place and makes sense. And that's what I think we're seeing now, that for a long time the economy was dominated by an idea that the macroeconomy was the key, and that you could get rates of return way in excess of rates that risk justified, and that the system was controlled by the government, and we could move the economy where we wanted to, and great people from the private sector could move the economic pieces around also, and they could prevail over microeconomic fundamentals. So that's what I think you're seeing play out now, and we're heading to a world where it's all microeconomic contracts, and I call it the macro denouement.